And here we are, guys. Live tonight, talking about creative financing and what are we going to do during this Corona time when we're not really able to get the traditional bank financing. Right now, a lot of banks are tapping the brakes, but yet there are potentially more deals coming at us because there are more motivated sellers. And so that's what we'll be talking about tonight. Hey, thanks, Anthony. Good to see you. Everybody go ahead and chime in on the chat if you're either on Zoom or watching live on Facebook or watching the recording. Go ahead and make comments in there. Let us know where you're from, what kind of investing you're doing, and we're going to be talking about creative financing, owner financing, subject to lease options. I'm going to try and put a little poll out here and ask a question to everybody who's out there watching on Zoom. Is, have you ever done a seller financing or subject to the existing mortgage deal before? Go ahead and weigh in. And I see that 3 people have voted. Go ahead and vote, everybody. We've got half the crowd has already. Chris Miners from Canada. Excellent. Larry's interested in seller financing.
Chapel Hill, North Carolina.
Yeah. Scott Jennings. South of Little Rock, nearby us. So of the poll so far, I'm going to go ahead and end the polling. And about 78% of you that, I'll share the results so you guys on Zoom can see it. 78% of you have not, and a couple of you have. So let's go ahead and jump into the conversation. I'm going to come over here and
While you're doing that, Paul, for those on Facebook, I am monitoring the comments, so feel free to ask away.
Yes.
And just a little introduction for myself here. This is Chris, part of the team with Cody and Paul. I do the sales and some acquisitions and some dispositions on the team. So happy to have you guys on here and hope you guys enjoy.
Yeah, likewise. Cody, go ahead and do an intro before I jump in.
Yeah, so we've done some seller financing before in the past with Chris, and we've recently jumped on board with Paul to form a small firm here to do wholesaling, buy and hold, and small flips.
Excellent. So the agenda tonight is we're going to be streaming for about an hour, up to an hour, answer questions and answers about creative financing. I'm going to do a little bit on the intros or the explanation of what owner financing and seller financing is. A couple of additional steps from what we've covered before. We've covered those in detail. I'm going to talk about the hierarchy of why I choose one type of structure over another, and when you're talking to a seller, what is going through your mind in the conversations and kind of the procedures of doing so. And then I'll actually cover a specific case study, and then I'll use that case study as an opportunity for you guys to create what offers that you could do yourself. And if you couldn't do this offer, then what is keeping you from making that offer? And those are the questions that we'll cover as we go. Let's just go ahead and jump right into it here. All right. So most of you probably already know this by now, but in case you don't, you're first time on here, we operate in Little Rock, Arkansas, and we're all full-time real estate investors, and we hold 50 plus properties, and we've done a bunch of deals. I also manage or run a podcast called Ready Investor One, and a YouTube channel where some of you may be watching this now. And then I host a mastermind and help busy professionals transition from working a day job, earning an income, to creating passive income through their real estate investments. And talking about the real estate investments, our favorite way to buy property is with creative financing, where we don't have to use a bank. And so where would we use creative financing? Why does that make sense? So basically, the big lesson that I want you to take away from this, if nothing else, is to hear that when we're talking about creative financing, we're talking about using what you know versus using what you have, which is your own cash. It's very natural and traditional for people to use their own cash and or go to a bank and borrow money. And I'm not disparaging that. There's a time and a place for doing that, but sometimes you can't. Sometimes the life happens, like right now, and banks they haven't completely stopped lending, but they're much more reluctant. And in the case like me and Cody and Chris, we are now self-employed, and we are not as classically bankable as some of you who have W-2 jobs. So what do we do? Well, we use creative financing. And so we don't rely on our credit in order to acquire properties. So we do seller financing, we do subject to the existing mortgage. And the benefit to us is that we don't have to qualify with banks. And we tend to get very good payment terms and have much smaller transaction costs because we're not having to pay the additional fees that's associated with more conventional financing situations. Plus, what you will learn from this and kind of see as you continue to watch is your imagination and your own creativity is your limit. There is ample opportunity in the marketplace, especially in today's, during the coronavirus situation, that people need to sell a house. They're uncertain, they're fearful, and they want some way out. And you may be able to provide a solution that they haven't thought about. This is, again, using what you know versus using what you have access to or the cash you have in your pocket. Sometimes people don't just want a big wad of cash. They want a solution that helps them pay for something in the future. And you can acquire and control property with little to no money. You don't have to follow the traditional rules. Now, I will warn you that I am not a big proponent of low and no money down deals and setting yourself up for failure in the future. So beware that you want to have cash reserve. So the cash that you do have, reserve that for your own running of your properties and not acquiring properties. What we do is we buy properties that have equity in them already, and the way we buy them allows us equity, and that's our cash down payment. So instead of using our cash to get a 20 or 30% equity position, we use our negotiating skills and our hustle to find that discount. So keep and reserve your cash for your own situations where you have to, sometimes you need cash and you solve for repair. That's when you need that sort of thing. So we have one question that popped up here.
We also have a question on Facebook too.
Okay, go ahead with that one.
Well, they're just asking, is the LLC a requirement to do creative financing?
It is not. Good question. Not at all. There are times when it's helpful, but the primary reason to have an LLC is to create limited liability. And that is really the primary driver behind that. And I will disclose here, I'm not an attorney, neither is Chris or Cody. We're not giving any kind of advice. What we're talking about is what we've done and how we behave. And you can take that as you see fit. Those kind of questions you would officially get an answer from your attorney. But my take on it in my situation is I do hold all of my properties in LLCs, but I do not, it was not necessary in order to get owner financing or subject to the existing mortgage. It kind of solves a different problem. And so we also have a question here from Chris Miner. I assume it'll be covered, but how do you find sellers willing to do it? And we're not going to go into a whole bunch of detail here. There'll probably be a subsequent situation, but what I'll say, that's a good question, Chris, because the context of this is how do you find them? Well, right now, I think there are a lot of people who own rental property who wish they didn't. And they would just kind of like to not be in it right now. So you want to go and find those people. And fundamentally, in our business, you want to find people who need to sell a house and don't want to sell a house. And there's a whole industry around going and finding motivated sellers. So it's a little bit outside the scope of this. But specifically for owner financing, it's people who have owned the property for a long time. So when you're doing your list or looking for properties, this is public data. How long has that property been owned? I would filter that out and not talk to people who owned the property for the last 4 years. If they bought it 2 years ago, very unlikely that if they want to sell it, they're going to be able to sell it under financing. They probably didn't buy it all cash. And if they did, they want their cash back. You want landlords who are own it free and clear or have a ton of equity and have owned it for a long time. That is the most classic scenario. And pretty much every owner financing deal I've done, with the exception of maybe one, have fallen in that category.
Yeah, and I had a good conversation today with a seller who, just from listening, he said, well, I don't want to sell unless I can keep getting cash flow. And so that way, that allows me to pitch him on the wholesaler financing thing, is he remains in the cash flow position, but removes his duties of landlord.
That's right.
That's
So
just
you turn them into a bank, right? Is what you're getting at.
right.
So most people who get into long-term buy and hold rentals is for the cash flow. So if you can set it up so they can still get a lot of cash flow with none of the headaches, and you manage the headaches for them, that's you turn them into the bank. You basically are allowing them to pay. You're paying them their equity over time, and you take care of the hassles. So another question here from Anthony: if you give a seller two different options, say one for all cash and one for less money, and another no down terms over time for no money, how do you compare the two options to see which is better for you? Perfect. I don't actually care which one's better for me, or I make the offer so that I will willingly accept any of the offers that I make. And I actually have a slide that I'll get to at the end that shows you exactly what I'm talking about. So stay tuned for that. It's a good question. All right, let's move on. Okay. All right, so let's talk about the hierarchy of buying. And here's where we really get into the actual conversation. Like, this is what's going through my head. This is the pictures going through my head when I'm talking to a motivated seller. Okay, so I am figuring out what their situation is. I'm asking questions. What are you going to do if you can't sell? How quickly do you want to sell? Just kind of figuring out and testing their motivation. It's like, oh, if you can get the number you want, what are you going to do with the money? To figure out what they're going to put it in the bank, or they're going to go pay for a bill. If they're going to go pay for a bill, owner financing doesn't make sense. But they have a mortgage on the property. And so I'm walking it down in my hierarchy. My first and favorite way to buy a property is number one, owner financing. And if you listen to me very long at all, you know I preach that a lot. It is the single best way to buy property. If they have a mortgage on the property, you still might be able to do a creative structure where you do subject to the existing mortgage. And depending on the terms of their mortgage, it might make sense for you to do that. Well, now sometimes it makes sense to buy it subject to the existing mortgage, but they still have a lot of equity in the property, and they don't want to just sell it for the balance of their loan, which is understandable in some cases, especially in higher value areas in the coast or like bigger cities where the property values are higher. They've paid it down and they want to get rid of it, but they don't want to sell it for $50,000 and it's worth $200,000. That's not going to happen. So how do you make the difference? You could do a combination of owner financing and subject to together, which is referred to as a wraparound mortgage. A wraparound mortgage is when you have a mortgage that is acting in second position that includes the first position mortgage, which is the subject to the existing mortgage that the owner has. So you call the paperwork actually refers to the existing mortgage and it wraps it around it. So it's a second position of payment. And you make one payment to the existing mortgage holder, you make a second payment to the owner. So it's the combination of one and two turns into 3-year wraparound mortgage. And every once in a while, you'll come across a scenario where you find out that the loan is assumable. This is not common anymore, but there are certain circumstances where that is possible. So VA loans, for example, are assumable. So in that case, or sometimes a lot of commercial loans, you can talk to the commercial bank officer and say, well, I want to just buy this property, but I want to keep the loan in place. And depending on the circumstances, you might find the bank willing to do that if they don't want to fuss with a new kind of loan origination scenario. That's typically where banks make fees, so that's not where they're not quick to do that, but it never hurts to ask. It does come up every once in a while. But more commonly, if you get through this hierarchy, you'll find that 1, 2, 3, and 4 using somebody else's financing is not going to work. Then you go down to another line, and you have to find somebody. You have to find personal financing. So personal financing is something where you qualify for your own loan, you use your own resources, or you go in and use other people's money. So you might use private money, which is another common way that the three of us buy properties quite a bit, is we use private money, and that could be cash. It could be in somebody's IRA. It could be in somebody's solo 401k. It could be in somebody's HSA, but it's self-directed. A lot of places where people have access to capital that they don't traditionally think they can be lenders to other real estate investors. So that's a big source. And I think a big opportunity in this coming market is getting good at raising private money, which I've spent the last 3 or 4 years doing that. And I feel like I'm positioned to do well in our market because I've been honing the ability to create private money. Number 6, which I don't do very often anymore, but it is a viable option, and some people only do lease options, but it's controlling or quote buying a property on a lease option. So you get a lease on the property with an option to buy it for a price in the future. I'm not going to cover that in a lot of detail tonight, but it is a creative structure that allows you to acquire property without all the money in your own pocket and doesn't require you to get financing from someplace else. And the third and the last one is still probably the most common way we buy properties is with all cash. But this is the way we negotiate, is that we take the all cash offer and we compare it to all these other offers that we are equally valuable to us, but we can potentially offer more money to a buyer or to a seller as a buyer when we offer terms versus all cash. And you'll see the example of that here in a second.
And Paul, I'm sure you're going to get to this, but there's an art of kind of walking that seller or that individual down a path.
There is.
Just come out of the gate to owner finance everything.
That's a really good point. I'm glad you brought that up because I kind of glossed over it. This is what's going on in my head when I'm structuring an offer. I am not throwing these terms around with the seller. No way. I'm talking about, hey, I understand that you need to pay for Jimmy's college coming in August. Would it be helpful if I gave you a down payment now and then made you $400 payments per month so you could afford to pay his tuition? That's the kind of way I talk about it. Or when it's subject to, I refer to it as, oh, would I be able to make payments from your mortgage and just kind of move on with life and I take care of all the hassle? How does that sound? Something along that range. I'm not using seller financing terms or owner financing terms. I'm sure not using, well, I could buy your property subject to the existing mortgage, or I could wrap your mortgage around it. No. That's going to confuse people like crazy. You want to talk to people on the level of understanding on this subject that they have. They might be very savvy people, but they're not conversant in this particular business because this is what we're in. So you want to use terms and language like you're talking to a fifth grader, because they probably have a fifth grader level's experience in this particular business. Just like I have that kind of experience in somebody else's business that I have no experience in. It's a really good point. Thank you for bringing that up to it. All right, so when you think about the sourcing of funds, sometimes it's better to think about the source of funds than thinking about what kind of deal structure. So there are a couple of ways to raise money for a property. And then my favorite one, like I've talked about and I continue to pound on all the time, is seller's equity. When you're buying owner financing, you're basically paying them for their equity over time. The other one is using somebody's existing financing. Then we go into private financing, and then you might consider partnerships. Partnerships are where you actually aren't using debt, but you're using equity. So you could buy a property has a bunch of equity in it. They might bring in $50, $100, $200,000 cash from their IRA, and they become their partners, not leverage. They're your equity partner. And this way, you can use. You don't owe them money. They get a slice of the cash flows or a piece of the equity when you sell it in the back end if you're flipping it. Want a comment here? I work alone for now, but I want to bring on a sales guy. I want to give him a slice. What commission? So it's pretty common if you're running a wholesaling business that in the Southeast anyway, about 15% of the deal is viable. Oftentimes what we'll do is we'll pay somebody $1,000 or 15%, whichever is higher. That's one structure that I've seen a lot commonly where numbers work here. If you're in higher value areas, Anthony, then those numbers might be different. It might only be 10% period, depending on if you're working in Dallas or Podunk, Oklahoma. And if we find a deal to get owner financing, how do I compensate him? I think you still pay them $1,000. Absolutely. Now, I'll tell you that it's tough to train outside salespeople to go after creative financing structures because they just don't have the training in it. So you're going to have to individually give them the training on it and then appropriately compensate them for the transaction fee. So think of it as part of your down payment. So if you're going to give a $10,000 down payment, then $1,000 or $2,000 or maybe more of that might be part of his fee. Or you may have to give $10,000 down and another $2,000 for your outside salesperson to afford the transaction. But I think it's worth it. They're out there doing a lot of hustle. It takes a lot of work to run down these deals and negotiate and to make offers. And if you're busy and you can't do it yourself, completely viable strategy. Good question.
Yeah, that was a good question.
Okay, so let's kind of walk through here. And so if you've done transactions before, once you get the property under contract, you kind of know how it works. You take it to the title company, you do your due diligence, you go to the closing table. And I've talked about those aspects of it here, but I want to focus more up here on finding the deal, asking the open questions, and presenting and getting consent. And that's where the magic of doing creative financing happens. The mechanics of the back end, once you get the contract, is actually not that hard. The genius behind this and your opportunity to really thrive is in asking the open-ended questions and figuring out their situation and structuring deals that work to their advantage and presenting it in such a way that they actually understand what you're saying and kind of see themselves thinking, you know what, this might work for me. Okay, so finding the deal, I send a lot of letters, or I haven't lately, but in the past I've sent a lot of letters to the landlords and found people who had portfolios, and some of them have sold their entire portfolio to me, and others have just sold to me one or two at a time. And I've bought from one person for sure. I've bought a deal owner financing every year for the last 5 years, and every year he says, I got another one for you. And I keep saying, well, I'm first in line, right? And because I don't want you to sell to anybody else. But I've built a lot of trust with him, and that when I make a payment every year on all these 4 or 5 properties, then he feels confident and comfortable working with me. So that's one way of doing it. And then when you are looking for this, I will have to fully disclaim here and disclose, most people are not going to go for it. And you're going to have to be okay with that. Most people are going to only accept cash offers. But it also makes your cash offer more enticing because it softens the blow, because you're giving them psychologically another option versus just being a schmuck coming in there and giving a bunch of low offers.
And something I want to further your point about the guy that you do one deal for 5 years. Sometimes it's a benefit to him as to not take a big tax burden, selling it free and clear.
That's right.
So it's a solution that you're providing to them as well.
Larry asked, do I use a third-party company to collect and pay the mortgage on your behalf? I don't, but I've heard of people who do that. I don't know the mechanics and details of using a servicer to manage the payments of an owner financing, where I'm buying it on owner financing, or I'm buying on subject to. I usually just make those payments. I don't find that to be a burden to just, because they're automatic payments out of my bill pay, out of my bank, and it's the same every month. I just don't find that to be a hassle. What I have found to be a hassle is when I sell an owner financing and remembering to check to see if people have paid, keeping up with the escrow. And on that case, I do use a servicer, and I've tried a couple different ones, and your mileage may vary on how much you like it, but at scale, I think you'd probably have to do that, or just make it a point to make a business around your internally of collecting all those payments. Okay, how do you guys know what is a good buy and hold, and just how good is it? What are your minimum requirements, cash on cash, return? So basically, what is your minimum deal criteria? And that changes as you what market you're in and what kind of what your goals are. But let's just talk about a buy and hold scenario, and it's in a market that you're comfortable in. And anytime you're making an investment, you want to compare it to what else could I do with that money. So if I feel confident that I could have my alternative is I could make 10% someplace else, then I want to get more than a 10% interest, for example. Or what is the going rate for properties in that area? What is the cap rate? What is the performance of a single family property in that specific neighborhood, in that specific market? And if the going rate is 8%, then I want to get something higher than the going rate, because I can just go anywhere and find an 8% cap rate deal. I want to go and find a deal where I'm getting a multiple of that typically. So I would say somewhere between 6 and 8 is probably minimum in most markets that can cash flow. There's a lot of markets where you cannot cash flow, and people would be thrilled with a 5% cap rate. So it kind of depends on where you are, but as you get more seasoned and savvy with this, that number goes up to 10, 20, maybe as high as 30% true cash on cash, where you're actually putting $10, $20, $30,000 cash into it, how much you're getting back. Now, I'll also warn you against using only the cash on cash return as a metric for how viable a property is, because if If you put $1 into a property and it's worth $100,000, but you only have $1 of your own money into it, and you make $2 in profit the entire year, you have 100% return. That's still not a good investment to take to a property that's only making $2 a year, because the likelihood of that maintaining only making $2 a year is unlikely. Your returns are going to go up and down significantly from year to year because of how much the expenses are and how unpredictable the expenses are in real estate. So you really want to give yourself a buffer zone in looking at the cash on cash. You want to look at the performance of the property itself less debt first. At its principal value, if you were to buy it with all cash, how much of a deal are you getting? And what people don't kind of get their heads around is, I don't look at just cash flow. I want to look at, I'm buying a $100,000 asset at 70 cents on the dollar. After repairs, 70 cents on the dollar. So if I'm buying it at 50, I'm putting $20,000 of borrowed money into it sometimes. Then I own a property that's worth 100 at 70. I just bought $30,000 in equity by just being there and out there and doing the hustle to get the deal. And it may get a 10, 12, 15% cash on cash return, but I'm getting a property for which I didn't really have any of my own money into it after it's all said and done, or little of my own money until all said and done, and there's $30,000 of equity. That's the powerful part of this, if you're going out there and hustling and finding off-market deals yourself. Which I will say, go ahead.
I was gonna say, we have a question on Facebook about, how are you finding seller financing deals? And it's more so what you said earlier about reverse engineering it to find the mom and pop who have had it for some time with equity in it. But there's no really one particular deal. It's more so the person and their situation they're in, and if you can provide them a better solution.
Yeah, that's a good segue into what I was about to say, which was you can find owner financing deals and occasionally a subject to deal through realtors and using MLS, but it's a lot harder. So you can go looking on the MLS for owner financing, seller will carry, and you do these search type items and find sellers who are actively looking for owner financing deals. Those are typically investors, and they typically want to sell to owner occupants. But every once in a while, you'll find a landlord that will market it that way. And I've bought properties through the MLS on those searches before. But it's been 2 out of, I don't know how many deals I've done, but it's been the exception, the notable exception. Where you're going to find these deals are typically off market, not on the MLS, and you're looking for people who have a divorce, have inherited a house, probate, same thing, have an eviction, have code violations, have tax liens against them. These are the type of direct to seller situations where you're going to find the potential opportunity to buy owner financing. And I find landlords are it, is getting in touch with your local landlord community. And it's a long play. You're not going to walk in the first day and say, I'm looking to buy properties, and have someone just throw in properties at you. It's a relationship. I was the president of the Landlord Association in Little Rock a couple of years ago, and I still occasionally get calls saying, hey, I remember you're the president of the Landlord Association. Do you know anybody looking to sell a house or looking to buy a house? Because I've got one and I'm kind of tired of it. I was like, well, as a matter of fact, I do know somebody, and that person's me. So your networking and your connections, relationships are a big part of that among landlords. And landlords are notoriously, I don't know what's the word, curmudgeon-y. They're reclusive. They're secretive. But they do go to landlord meetings, and you can find them through the landlord meetings. That's a good source of leads that I have found through just random pure chance. I just was trying to learn and went to landlord meetings.
And that same person would like to know if there's a cheat sheet too for your open-ended questions to kind of walk that seller down that path.
Yeah, there is. I'll give you a chance to text me later on, and I'll send you anything on the slide deck, all the paperwork that I have, and one of those is the present and get consent kind of cheat sheet of questions. And basically, you think about it, and this all comes from the book How to Split or Never Split the Difference by Chris Voss, and it's asking open-ended questions that start with how and what. How does this work for you? Or just asking open-ended questions like that. Because there's no like magic formula. You can't say the right thing to make this always happen. If you genuinely ask questions about people's situation, people love talking about themselves, and especially landlords tend to be older and they tend to have time. They don't have a job anymore. They have nothing but time to talk, and they'll talk your ear off, and they'll tell you all about their situation. And that's an opportunity for you to develop really good relationships with some really interesting people, and to get to know people that have been around for a long time, because you don't want to be the tired landlord in 15, 20 years yourself. So you want to make sure you're not stepping into the same problem that they found themselves in. All right. Good conversation tonight. Okay, so how are we doing on time, guys? 6:30? Let's run through a case study, and I'll kind of judge the audience on how much people are interested, and I'll kind of go through real fast or really dig into it depending on the situation. So this is a property that I bought, and it uses a couple of different creative financing strategies. So a wholesaler brought this to me. It's a 3-bedroom, 2-bath starter home in a Class B neighborhood at best, and it was worth around $94,000 in 2016 when I bought it. And the wholesaler was coming to me saying that he had a contract, and he, including his assignment fee, was $56,000. Turns out his assignment fee was $4,000, and the seller was for $52,000. So it needed a fair amount of repair, $10,000 to $15,000, and you'll see some pictures in a second. Not scary stuff, just basically it needed everything, new flooring, paint throughout. So about $10 a square foot, you're going to be right at $13,000 to $15,000 of repair. And the market rent was only $800. So it's kind of a thin deal if you look at it. If you do the numbers, it is a little bit thin. So I thought, well, I don't know if I just want to buy this one. And I don't want to go get a bank loan and buy this. So it's like, let's use what I know in my network and see what I could do with it, knowing that I could on the back end do a refinance it and still have a little bit of cash flow. And I'll show you the numbers on that in a second. So owner needed $40,000. So what I did is I talked to the seller, or to the wholesaler, who was pretty young, and so he was getting experience, a nice guy. And I said, I'm going to pay you your assignment fee, but I want to go and talk to the seller and see if we can negotiate some financing. And he said, there's no way, they're not going to do that. I said, well, I want to go ask, so I'm not going to cut you out of the deal. I'm going to pay you your $4,000 if we can make this work, but the deal's thin, and I want to make sure you get your $4,000. And you can come with me. Like, I'm not going to cut you out. I want you to learn this too. So we went and talked to the seller, and they had inherited this property. Their mom or dad, I can't remember, lived there, and they were trying to do repairs on it, and they died kind of, suddenly, and the house was just lived in and just kind of there, and needed to be updated quite a bit. So the seller didn't need money. They just wanted this to get rid of this property, but they would not come off of having a $40,000 walking away. It just, I don't know, they would not tell me what they needed it for, but I suspect they owed money somewhere, and this was a big opportunity for them to kind of set the slate clean and get $40,000. But they were willing to take terms when they were renting $16,000. As I told them, I want to make this work, but at $52,000 for you and $4,000 for the wholesaler, it's too thin. There's not any room for it because it needs repairs all the way through. So they agreed to take a $16,000 financing, but they wanted that to be paid back in 3 years, which isn't ideal, but it's the best I could get. So I worked with them. I said, okay, well, if I can make it work and pay you off the remainder in 6 years, would you take $100 a month in payment, knowing that and you got $40,000? There's no way I'm gonna walk away from that. Like, that's fine. We'll take $100, and that turns out to be 0% financing. They did not. That is not any interest on top of that. That's just principal. So it's the same amount of money, but it's slower. And anytime you owe somebody else's money, you want to slow down the payment to them as much as possible. So I still need to raise $40,000. So I found a local private lender here in town, and I can't remember, but I think it may have been out of an IRA. I don't recall actually, but the payments were $333 a month at 10% interest only. I was not paying principal down. So that gives me a total payment of about $433 of mortgage payments of a rent of $800. So again, kind of thin, but it was enough that if I exited the right way, that I would still have some cash flow there. So This is kind of a combination of owner financing and a lot of cash, and paying the wholesaler. And then I need to solve for the repairs. So you see the property again. It wasn't terrible. They had been there trying to clean it. You can see all the water balls there were where they've been trying to, clean, and it was dirty and it just needed updating. You could probably salvage those cabinets, but definitely needed new countertops, definitely needed new flooring, needed paint absolutely throughout. It was just kind of dirty. So what I did is, instead of raising another $15,000 to do the rehab, what I did is I said, well, how about I sell this on a lease option and sell it in as-is condition and let somebody else do the sweat equity, because I wasn't going to do it. So I ended up finding a buyer that would be a resident and rent it for a while and then get qualified in the next couple of years. I think within 3 years was a term. And they would buy it in as-is condition, and I would give them a washer and dryer. Actually, it came down, the reason they were able to do it is because they were ready to go. They had the $3,000, they had enough for the payments, but they didn't have a washer and dryer, and that was busting their budget. I said, well, I just happen to have a washer and dryer that's extra from another rental property. I'll just throw those in. It actually is causing me a problem having to maintain them. So how about you take those, but you take them as is. I'm pretty sure they work, but they're yours. And that was actually what sealed the deal. So that's what I'm talking about. Listen to the problems people have. What do they have a problem with? And this deal happened at the very end because of me being able or willing to give up a washer and dryer, which actually is solving one of my problems. They came to my personal residence in their truck, in their dolly, and got a washer and dryer that was sitting in my porch that I wanted to get rid of. So it worked out perfectly. So a buyer agreed to do all the repairs, and after you run the numbers, I was making somewhere between $100 and $150 a month in cash flow. Not the greatest thing ever, but I wasn't losing money either. And again, I have no money in this deal.
Yeah, and the thing about that point is, that 130 is not a lot, but you add that over time, you have 10, 20 now. Then it begins.
That's true. It does add up. That's right. I mean, I prefer to get closer to 250 per door now. That's kind of like my bellwether. Like someone asked what was my criteria. If I'm not making 250 on a house, I'm not sure it's worth the headache. But this was 4 years ago now, and I was relatively new at doing this, and I was just trying to get experience. My goal in a lot of these were just to get some experience and not lose money. And it turns out I made money.
Hey, could you explain to them why it is that you do interest only instead of principal reduction as well?
Sure, because it was a short-term loan. So this was going to be only a 3-year private loan. So I wanted to be able to, because private money tends to want a higher rate of return, more like 8, 9, 10%. That's kind of the going market rate for most private individuals. They don't want to get 6%. It doesn't work for them. The banks will get 6%, but the person wants higher because they could go to the stock market and get 8, 9, 10% over time. So why would they get 6% and not be, what is their alternative use of money? Something higher than 6% most likely. So for me to be able to afford the cash flow at 10% interest, I do interest only payments for short terms, and then I have to exit somehow or another on the back end. And you'll see why. It'll kind of come clear in a second, I think. Okay, so here's the results of the numbers anyway. So the tenant buyer qualified for the loan in 27 months, about 2 years later, a little over 2 years later. And I had a 3-year timeline on this. Remember, I was supposed to pay back the owner financing to the seller in 3 years, and the private lender wanted their money back in 3 years. So, which is for a private lender, typically a fairly long term. Most private lenders want their money back within 6 to 12 years, or 6 to 12 months. But I'd used this private money before. I knew them pretty well, and they were cool with 3 months, for 3 years. So the end sales price was $83,000, and I'll just explain why it was 83. I probably sold myself a little bit short on this one, but I didn't know what I was doing. I took a $3,000 down payment option fee from the tenant buyer in 2016, and I got the $130 or so per month in cash flow over those 2 years, which is a little over $2,200. And then again, remember, I'm paying principal only to the seller of $100 a month. So I actually get that principal pay down back. So it's another $27 in profit that the tenant buyer was paying, but I was the one paying it, but they were actually giving me the money. So that's part of my cash flow. So that's some extra cash flow. And then $83,000 sales price minus the $53,000 that's been discounted from the $2,700 of the $56,000 sales price. So a little under $30,000. You call it $29,000 of profit, less the $3,000 that they've already given me. So I got $3,000 first, $130 a month, and then about $26,000 at the end of the whole transaction. That's referred to as the 3 bites of the apple. The first down payment is a little small chunk, and you get these little bitty tiny chunks of the apple over time, and then you get the big back end money, which is the equity, which is the big bite of the apple at the end. 3 bites of the apple. And a lot of lease option deals have that built into 3 bites of the apple. And I probably could have sold this for a whole lot more, but in my mind, I was thinking, well, it needs $15,000 worth of work, and it's worth about $94,000. So, I can't sell it for 90 grand. I bet you I could have sold it for 90 grand because the terms I was offering to the buyer were favorable, and they were going to do the fix up, and they did a decent job fixing the property up, and it was able to appraise for $98,000 when they bought it. So when they bought it, it appraised for $98,000. So I've left quite a bit of money on the table, but it's a really great family, and they're probably going to be there forever. And so I got about $20,000 of profit after factoring in transaction costs, which I've kind of waved my hand over this for. I haven't talked about closing fees and that kind of stuff. So before taxes, I probably made about 20 grand on this deal, just to be round numbers about it. So overall, it was a winning proposition for everybody involved. The private lender got return on their money. The seller got their cash up front, plus payments over time. The tenant buyer got to get into a property for way less than they would have been able to get otherwise, and they got to try the house out before actually getting qualified for the loan. Now I'm going to talk about some caveats that were with this here in a second. But what's really important to remember is these transactions, you don't really know all the details going into it. And I could have lost money in this if I hadn't been careful, because I wasn't factoring in the fact that I got lucky, I think, because the 3 years that I owned it, what if that tenant buyer hadn't qualified? And a lot of tenant buyers don't qualify. So I would have had a 3-year kind of time lapse here, and I would have been kind of in a pickle, and I would have had to sell the property or refinance it. So I actually ran the numbers as though back then I ran numbers as a backup plan. And this is the first time I did this, but one thing I haven't mentioned, and this is kind of the big secret for tonight that most people don't talk about, is setting up the deal after the deal. So what I did is I reserved a first right of refusal on this property. So they've sold it 2 years ago. This is 2020 when I'm recording this, and they bought it from me in 2018. I attached a little rope to it with a yo-yo on it, called it first right of refusal. And what that does is I'm first in line if and when they ever decide to sell it. And I have to map their terms. If they decide to sell it, they come to me first saying, I need to sell it. And we should be putting this clause into every time we're buying owner financing, anytime we're selling owner financing, or selling on lease option. You attach the first right of refusal. It's just a clause in a paperwork, a clause in a contract, and then I record a separate affidavit of a first right of refusal at the courthouse, so that if they go to sell it and they don't call me like I asked them to, then I'm first in line. Now, do not confuse this with what is commonly referred to as yo-yo financing from the car dealership space. I am not trying to set anybody up for failure here. If they decide they're going to sell the house and I can't match their terms, I'm going to let them sell the property. I'm not trying to juice anybody. But how many people do you think actually live in a house for 30 years on a 30-year note? Very few people. I could buy this property back from them again in the next few years, next 7 years from now. I've just set up a deal source for me on all my deals by attaching this first right of refusal, kind of a yo-yo properties. And I have met investors who have been doing this for 30, 40 years who have bought the same deal, the same property 3 or 4 times doing this technique.
Yeah, I like what you did about this deal is you used your tools that you built up from your education and just put all the right pieces in place, you know.
Yeah, I stacked quite a few things together for sure.
That and then just the back end exit, you know, going into the buying right. You know, you hear, you know, you make your money when you buy it right. Or, you know, you walked away with 20,000 because you bought it right on the front end, which
Hmm.
is when you make your money. It's just not now, it's later.
And it was a thin deal. I mean, but I'll tell you, in our market, in similar markets like ours, there's a deal like that every day in your market. Um, Happens all the time. It's just a little thin. It needs work, and it just isn't there. Like if you just had cash, and that would not be the best use of your $54,000. But if $56,000, but if you had access to creative financing, the financing sometimes can create a situation because what you're doing is you're playing arbitrage. You could go and make 10, 12% percent on your money, but it takes a lot of work. There are people who have access to money, like the seller's equity, that they by leveraging up their 0% financing, I was able to get into a deal for a lot less, effectively for a lot less. The net present value of my purchase price was less than $56,000. Okay.
Question here. How many offers do you guys make on average before you get a deal?
Dozens, scores, sometimes 100. A lot.
Yeah.
And within the last 3 or 5 years, the last 2 years has been even harder. With the coronavirus, all those numbers are the world before and after the coronavirus is a different set of rules. So don't take the numbers that we take from the last 3 years or 2 years or even the last 6 months as some indication of what's happening in the future. I mean, it's a different world, and we don't know exactly how much it's going to affect the market yet. I mean, we're still kind of reading it, so time will tell. Go ahead.
I was gonna say, it's a good thing about real estate is, you know, they ask how many offers you make is you get to pick and choose. Just because you make an offer doesn't mean you have to follow through with it.
That's right.
Move on to the next one.
That's a good point. I've made a lot of offers, and people said, "Yeah, I agree with that." And then I went and looked at the property, and thought, "Oh, no, I'm sorry, that it just doesn't work." And so we either renegotiate or the deal doesn't happen. It's got to be a win for both sides. So here is actually the actual back in 2016. I actually ran the Bigger Pockets formula, their current tool, which looks a lot different now. And I just ran it as though I were going to buy it after the 3 years. I was going to buy it with a refinance with the commercial loan to just kind of, if that 3 years happened, what could I have done to mitigate the situation? And so I would have had about $130 of cash flow. And I'll let you guys look at the slides and details later. We've been kind of belaboring this point here, but basically the back end of this is that I did not paint myself in the corner. I knew that, or I felt confident that I would be able to get qualified for one of these. At the time, I was employed and I was bankable. At now, I'm a lot more careful. I'll explain to you what I will do differently now. We are adjusting, and yeah, we're adjusting a lot. I'll talk about that in a minute, Anthony. Okay, I'm not gonna. Y'all gotta look at the slides when we get down here. This is just more numbers.
Hey, while they're looking at that, did you have to customize this with an attorney?
So this was not the first time I did this exact same deal. So I had paperwork from deals. So I had lease options, I had the owner financing terms, and so there were forms drafted by an attorney, and I just changed out the numbers. But the original forms were drafted by an attorney. But you can absolutely run it by an attorney every time if you want to. If you're not confident in the details, run it by an attorney. Don't be cheap with the $250 an hour or whatever your market rate is for an attorney, for a good real estate attorney, because making a mistake could cost you thousands if you don't get a good advice from a reputable, experienced attorney in your area for your local jurisdiction. Okay, so here's one of the things that I would do differently. Here's one of the things that I would learn. So I bought this property, took title to the property, and then marketed it for a tenant buyer. I would not do that anymore. Knowing that I am not bankable in the traditional sense anymore, knowing what's happening with COVID-19, I would pre-sell the home. So I would get the property under contract first, and then I would market it to a tenant buyer, and because it was vacant, and with the permission of the seller. And then once I had a qualified tenant buyer, then I would do the deal based how I described it. I wouldn't have taken title and then gone to make a market. I would have made my offer contingent on finding a qualified tenant buyer. Another way you can do that is initially market for tenant buyers and then go and find the deals that are out there. And I'm not sure that we've been doing that enough in our market. In fact, I know we haven't. There are a lot of people out there who are qualified or who cannot get traditionally qualified for financing, but have cash or have capital that they can buy a property with, and or would be great tenant buyers. But so you find them first, which they are plenty, and then you have them go and find the deal for you. That would be another way to approach it. So an alternative ways I could have structured this deal is that I could have sold it on owner financing instead of selling it on a lease option. And the only reason I would have done that is if I had favorable terms on the creative financing. That 3-year balloon that I had built in there made me super nervous. So if I had sold it on owner financing with somebody who'd given me a down payment and moved in and been on a 15-year term, and then that 3 years went and passed, and I couldn't solve for the underlying financing, I owed the private money lender and I owed the seller a balloon payment in both cases of about $40,000, $50,000, $4,000, what it was. Then what would I have done? Well, I would have had to refinance, and if I wasn't bankable, what do I do? So I didn't want to get in that position. So that's why I sold it on a lease option, so that they had the obligation to solve for their own financing within 2 years. That was the terms, and I think it took them 3 months longer than I wanted them to, actually. So I gave myself a year buffer of the 2-year option and a 3-year balloon, and that wasn't enough. I got lucky. There have been a lot of situations where that's happened, where the person did not get qualified and they just turned into a tenant. And what would I have done in that situation? I would have had to sell the property. If somebody lives in it as an owner financing buyer, they don't want you to sell the property because you've already sold to them.
Yep, that's why you got to buy it right on the front end.
Yeah, you got to get these terms, but this seller just was not negotiable beyond the 3-year balloon. So I had to sell it in a way that made sense with the underlying financing. So another option that would have solved for all that was to partner with somebody else's IRA and split the equity and split the cash flow. So I could have brought in the $40,000 IRA partner who just wanted cash flow and was in it for the long term. That would have been another option. At the time when I did this, I didn't know that was even an option. I wouldn't know how to talk about it. I wouldn't know how to get the paperwork. It just wasn't in my repertoire at the time. The other one is to partner with someone else who is bankable. So what you could do is partner with somebody who has a working job and they want to own a cash flowing property, partner with them and let them get the financing, and you split the income and or equity of the deal. That's a third way to do it. So I've been talking a lot. What's the questions here?
Real quick, one of the things from what you learned about marketing for tenant buyers to find the deals for you, one of the strategies, a creative way, is to market to Craigslist and to say that, hey, you've got a certain type of property and you can build up a list of people that are looking for a certain property of that make and model. So you can,
if you put an ad out there on Facebook Live, Craigslist, or just a general Facebook post and said, have property we'll take owner financing, must have a down payment, call to inquire, and do that in both the English speaking forums and the Spanish speaking forums. If you have somebody who can translate, or if you are native in Spanish or you can speak Spanish, there is a huge market of people who will, your phone will just ring off the wall. It'll shake you out of your chair. It will ring so much.
Is that one of those ask me how it knows?
Well, I mean, you witnessed it, right? When you put an ad out there, man, there's a lot of people. You'll get a lot of interest in when you advertise for people wanting. When you're offering financing, owner financing, no banks, you put that in there, your phone will ring.
Facebook Messenger alone, you get 20, 50 people a day.
Really, that much? Wow.
Anthony has a question. So after his first question, he said, how are you guys adjusting your strategy because of COVID?
So we're offering a COVID discount, basically, or we're asking for a COVID discount. And here is the great insight that I had just this week, talking internally with our team. This week, we're switching to looking to find properties in a different way. So now there are probably more sellers than there are buyers, which was the reverse just 6 weeks ago. So now go and find the buyers who are actively wanting to buy, whether they be tenant buyers or other investors. Go and find them and really understand what they want. And then go and find offers, or I'm sorry, go and find properties and make offers that align with what they want. So for example, if you know somebody will only buy a 3-bedroom, 2-bath house, and they must have a 15% cash on cash return, and they will only buy properties, built after 1960, and they must have brick all around. Well, now I know what to filter for. I know where to go and look, and I know what my buy box is. I know what their buy box is, and then I can go and find a deal that fits that. And then when I make an offer, I can make an offer based on my end buyer getting a 15% cash on cash return. And I might just go ahead and buy it myself, but I know that there are other people behind me that will buy that same deal based on those terms. Or a tenant buyer who I know what they want, and I know that they're willing to take a property that needs work, or I know that they will only take a property to fix up. So maybe I will buy it, fix it up, but then I have an end buyer in place. So this is not a time to speculate on what the market will do. Go and find somebody who has cash in hand or has financing in hand and is locked in, and solve for them their problem. That's what I would say the change in the market is right now. Because you can't predict what's going to happen next. That's the problem. Okay, so I think this is one of the last slides, and this is just kind of an example of the same situation. The property is $94,000 ARV. It needs $15,000 of cosmetic repair. If you were to run the Mayo formula on this, our buy price without wholesaling it would be $50,000. If you want room to wholesale it, then at say a $10,000 fee, then our wholesale offer would be $40,000. So the seller wanted to sell it for 52, and they would not budge at 52. So we were not close enough, or we would not have been close enough, right? And so in this case, a wholesaler beat me to this deal, and he wanted to sell it for 56, and the numbers didn't work. I mean, it doesn't meet the Mayo formula. It just is too thin. So what do? Here are some alternative ways of making that same offer to see how it works. And you can do this much better if you have native access to the seller yourself and not having to go through an intermediary. Yeah, so those of you who don't know, the MAO is the maximum allowable offer. It's called the Mayo formula. I've got a video on my YouTube channel about that if you haven't seen it before. So I kind of run down this rubric, and I wouldn't present this 7 offers to a seller. I would run through this kind of exercise myself and figure out what the different offers were and where it makes sense for me. So the big distinction here is I could buy this property for as high as $70,000 if I put no money down and only made a $291 payment per month for the next 240 years. I dare say I would even buy this property for $1 million. How could I afford to buy this property for $1 million? Anybody dare to hazard a guess? How?
I'll guess as long as that monthly payment's reasonable and you stretch it out over time.
Right. So how about I pay you $1 per month until paid for $1 million? It's going to be 1 million months. The sun might burn out first, but those terms work for me, right? So don't limit yourself into what you're used to seeing. All you have to do is get one person to accept this, and that's a seller. And you just never know what people will accept. In this case, the seller took some hybrid of this where I made a $40,000 cash offer and a $16,000 finance offer. So I could do any number of that situation. I could have bought it for $55,000 and put $20,000 down and financed it for $35,000 at 180 months for $300 a month. And you notice that 5 of these deals have payments, right? And all the highest payment I have in here on number 6 is $350. Anything higher than $350, even $350 is a little bit pushing it. If the rent is only $800, then I can't have my mortgage payment be much higher than $300. So my target on this was to keep my mortgage as close to $300 as possible. Now I'll do a slimmer cash flow in the short term if there's some sort of kicker in the back end that makes it so that I can make the $20,000 in the back end. So I'm going to share these slides with everybody who text the word investor to the number 33777. Or if you're already on our list, you can email us and say, hey, I want the slides, I want the paperwork, and I'll share everything I have on creative financing. I've already shared the sub-2 and owner financing docs I have. If you don't have those, I will send those to you. That stands for anybody who's listening to that. Again, full disclosure, I'm not an attorney. These are documents that I've used on the previous deal. Take them and use them as an inspiration for you to go and find your own docs with your attorney in your jurisdiction. But now you're armed with something that's practical and specific for your market. So let's open up some more questions. And we're at 7, but I'll go longer, as long as 7:30 if you guys have questions.
You know, and pretty much what I'm gathering through creative financing is there's multiple ways to put deals together, and it's all up to what's in your arsenal to figure out which tool you want to pull out the tool bag to get that deal closed. And it sounds like all you're doing is just putting the right pieces in place, connecting the dots, and just having that access to money is really what is kind of going to seal the deal. And if you can confidently come to the seller and present your offers in a way that works for them and you, then like you said, you can get into a deal, no money, make 20 on the back end, all while small bites during the meat of it.
I agree. So one of the questions that someone said here, let me change the slides. It was this slide. I showed the process. Chris had a question on the process. So I have to go all the way back. Sorry, guys. And it's kind of slow, but I'm going live. It takes a while for me to move back here. So she commented on the documents that were required. I had promissory note and mortgage in here. So she asked a question about, well, if it's a sub-2, do you need the promissory note and mortgage? And no, you don't, unless you are agreeing to pay some part of their equity on the back end. So you will use the documents appropriate for your deal. In this situation, I was doing a promissory note and not a sub-2 because I was borrowing, or I was agreeing to pay the $16,000 to the seller over time. So they got a promissory note mortgage. If the appreciation is good, will you buy it at 0.8 to 0.7%? The problem is I can't count on appreciation. It's awesome when it happens, but I don't speculate on appreciation. I buy on the cash flow primarily, and then on the equity in the deal now, because it might depreciate a little bit. We happen to live in a market that is pretty steady. We don't have much risk of the market going down that much. It could happen, and it does happen time to time, but we don't have, we're in the center of the country with lots of land and lots of available workforce and a smaller population. So the cost of land and the cost of building is relatively low. So our housing costs tend to be low. So we don't have the fluctuations in housing values the way the coasts do. So I don't really make a lot of buying decisions based on appreciation. It'll happen, hopefully, but I stick to the 70 or 65% for the Mayo formula. So now, as it stands now, I would, and other buyers that we're talking to, that number is coming down, not going back up.
We got a good question on Facebook.
Go ahead.
How do you formulate the $350 payment as your max, knowing that the rent's going to be $800? And I know you kind of reverse engineer.
Yeah. So whatever the rent is, absolute max that your mortgage should ever be, and that's still too high, is 50%. So I basically believe that in most markets, there are a few exceptions, but most markets, that 50% is the expense ratio of holding a property. So if the property rents for $1,000, then my cost to hold it are going to be no more than 50% per over time. So I don't want my mortgage to be any more than 50%, because if it's more than 50%, then I'm in a negative cash flow scenario. So in reality, I found in my market that our expense ratio for a property managed portfolio is between, including property management, is between 38 and 42%. So that's our expense ratio. So if I am making a mortgage payment at somewhere between 30 and 40% of the monthly cash flow or the monthly rent, then I know I'm leaving myself about 10 to 20% per month of cash flow. But you want to run those numbers for yourself, because there are some states where the taxes are really high and the expense ratio might be 55 or 60%. And so your mortgage has to be even less.
And there are some cool tools that you showed me with the whole calculators and stuff of backing into it, knowing that your payment's going to be $350 and this principal balance.
Yeah. So I use a tool on my phone that's just an emulator of a financial calculator called 10BII. It's a model number of a manufacturer from many years ago. There's a lot of tools. Dr. Carl's is a good mortgage calculator online. If you just look up mortgage calculator, if you don't know how to do the math yourself, you can find a calculator to just run the numbers for you. And you just have like little slider dials that say, if I make, if my interest rate's 5%, and this is how much. So for example, what we're talking about is how do you calculate that on number 6 that the payment is $350. That's the least option, never mind. Number 5, how do I know the payment is $300 at 3.9% for 240 months at a finance amount of $50,000? You need a mortgage calculator to do that. It's not something you do in your head typically, unless you're like Rain Man. And I am not.
Hey, what service do you use for collecting mortgages?
So I've tried a couple different ones. Right now, I'm using Madison Management, and it's okay. It's good enough. They're a little bit expensive, and it takes forever to onboard a service with them. As of now, I'm recording this. It's taken 2 months to onboard a note, which is too long because the end buyer, when their payment is due 30 days afterwards, and so the first payment or two often has to end up coming to me. And then they get confused when this third party contacts them. Kind of a hassle. Madison Management, yeah. But once it gets set up, they're good. Yeah. So if you want any of this information, text the word investor. So I even did a little screenshot of my own phone here. So if you go to, some people don't know what that means when they say text the word investor. So you go to your phone and you say to the number 33777. And you type in the word investor. As soon as you do that, you'll get some prompts, and then you'll be on our email list, and I'll send you all those. You're going to have to email me manually and say, "Hey, Paul, I want that stuff," because I don't know who's contacting you. I don't know anything about you other than your email address.
We got one more on Facebook. Is the for, let's see, put insurance, taxes, payment. Is 50% just the principal and interest, or taxes and insurance as well?
So the 50% rule, if you're not familiar with it, is basically says that a half of all your monthly rent goes to the operating expenses. It does not include your principal and interest, or it doesn't include your mortgage at all. So in order to figure out how much you can afford for a mortgage, you need to factor in how much is taxes and insurance, property management, vacancy, and repairs going to cost. So when you're buying a property with the intention of selling it owner financing or selling it on a lease option, you can largely exclude the repair cost, because you're passing the repair cost off to the owner occupant. Not to say you won't ever get a property back and it needs repair, but you're from a cash flow perspective on a monthly basis, you're largely expecting it to not be your responsibility. So if it's not, then that's a little bit more cash flow. Excuse me. A little more cash flow that you may get. And so you can afford maybe a little bit higher mortgage, but generally speaking, the 50% rule takes in those 5 factors, and it is assuming that 50% of it is going to operating so if you have no mortgage, you still got to pay your taxes and insurance. You still got to do repairs, that kind of stuff. Are you adjusting your ARV lower for the coming downturn when buying? Yes. I don't know about how much, but I am offering a COVID-19 discount to sellers. That discount is to me, not to them. I guess it is a discount to them, but I am not going to push the boundaries on what I'll buy a property for.
We got a question on Facebook. How come you didn't use the HELOC on doing a creative option for financing?
I could have, yeah, yeah. I have before on this one. At the time, I'm not sure I had one. Yeah, I hadn't opened up a HELOC yet, but you could. But I prefer to use the HELOC unless you have a big old HELOC. And like I work with a lot of people who live in California, and they have very high valued properties, and the property may be worth $500,000 plus, and they have a $200,000 mortgage, and so they have this $300,000 HELOC that they buy properties with, which is fine. Just know that's a short-term solution, and you'll want to get it into long-term financing afterwards. You use a HELOC kind of like you use a cheap credit card. It's just a short-term loan, and you may pay 5, 7, 8% interest depending on the market right now, and that's fine because that's what I'm doing for private money myself. But my whole property, my whole house is worth $250. So I mean, I can't even get that much of a HELOC. So you only have so much access to your HELOC after you tap into a little bit. But I still use my HELOC for deals. But I mean, I don't have $300,000 HELOC.
So Paul, real quick to sum it up here, because we may have had a few late people join.
Yeah.
What is your overall benefit if you had to do like a one-liner or a few bullet points of owner and creative financing?
Flexibility. Yeah, the value of owner financing is having an arsenal of options to solve the current problem you're faced, the current problem the seller is facing. The problem when dealing with just banks and just cash is that if you don't fit into their box or their credit rules change, then you're stuck. And if you only ever exercise banks, then you're leaving a lot of opportunity on the table, and you're not preparing yourself for the recession, which is, we're afraid that we're going into one right now, and things don't bounce back pretty quickly. And banks, there's like a lot of speculation as to what the banks are going to be doing and what the market's going to be doing. And I don't rely on banks. I can still do my business without banks. And that gives me an advantage to where I can, because I was around in 2008 and I saw that it was the opportunity of a lifetime, and I was not prepared. I didn't know what to do in real estate. And so I have been studying since then to prepare myself for when it happens again, to be uniquely situated to be able to handle it when banks can't lend or won't lend, or they're just tighter.
Got it. Thank you. So flexibility it is. And for me, it's more so just getting into it little to no money down. And that's helped us tremendously, and just going around the banks.
Yeah, Johnny asked a question that I'll answer live here, is that what percentage of my tenants are unable to pay their rent? And so far, I haven't had any tenants who have not been able to pay their entire rent because of what's happening. But it's really only been 1 month. So it happened in March. Most people paid in April. May will be a different conversation. We don't know. But so far, nobody's telling me that they're done. Anybody who I know, I do know a friend in town that he has, I think, 4 tenants who are saying that they can't pay, and at least one of them for complicated situations is not eligible for the unemployment, the federal boost, and so he doesn't have access to cash, so he might be stuck on that one. So that's going to happen somehow, but so far what we're seeing is that in the single family space, it isn't that bad. Now in the multifamily space, I'm getting a lot of numbers that the pay rate on the multifamily space is not anywhere near as high. Good question.
Yep. And just to further the point about the flexibility, when Cody and I were first getting started, we went to the bank because we thought that was the only way to do it. And we got turned down by the bank because we weren't bankable because we had a high debt to income from previous purchases of properties. And so we kind of let that at the time, like get the best of us, because we didn't know that creative financing was an option. But once we learned that, we were able to leverage that strategy to get into a lot more properties and not have to worry about the whole debt to income ratio with the bank. And that has been super helpful for us to get into property with little to no money down.
Yeah. Preserve your capital for those emergencies, because sooner or later there's going to be a roof that you got to replace. There's going to be a sewer
virus
line.
that hits, or
A virus. There's going to be a virus that hits.
Yeah,
That's a good point. Reserve your capital. I've got friends with a lot of money in the bank, and they're like, well, why don't I just buy it myself? And I'm like, well, then you just buy one, and then you got to wait more time to buy your second one when you can leverage.
It depends on what your goals are. If you want a place to stick your capital, I mean, if you're well capitalized and if you inherited $2 million, then there's no reason to leverage. I mean, I say no reason. It's just you may not be experienced enough to leverage. So it really depends on your personal circumstances. And if you're bootstrapping yourself up, you're in your 20s, or you're just getting started in real estate, and you have limited access to capital, $15,000, $20,000, keep that capital in your cash reserve and buy one property using a basic, simple creative strategy where you're buying into a property for a lot of equity. So it's the same difference of putting $20,000 into a $100,000 property and having an 80% loan to value loan versus buying it at a 20% discount. I mean, but you're using your time and effort and what you know versus what you have to get that 20% equity. And that's the message I'm trying to explain here is if with a few basic techniques that you learn how to do, you can you can leverage yourself up into equity position without having to actually put cash on the table. You keep what cash you have in your back pocket for those rainy days when stuff happens and you need cash. Okay.
Anthony had a question. How many months reserve do you hold per property?
Ideally 6 months. Yeah. Keep 6 months reserves in there because you want to be able to be in a place where you can hold on to a property for a year and not get any income. So if you have 6 months of reserves and it costs you half of your monthly income to run the property, then you can hold the property free. That's free and clear for 12 months. Yep. But let's be honest, that's hard to do. When that money starts piling up in your bank account, you just get so excited you want to go buy something else. Yep. Oh, what's a good resource to learn more about owner financing? So there are a couple books out there. One of the first ones I read was from several years ago. I'm trying to think if I have it handy. I can't put, it's Investing in Real Estate, Become a Millionaire by Investing in Real Estate. And it was written, 25 years ago. And that's all they talk about is how to create terms. It's really cool. If I can remember the exact author's name, A Weekend's Guide to Becoming a Millionaire. He talked about, that's actually two guys, they talked about how they both had jobs, and on the weekend they went out and would make offers, and they make up to 100 properties, all owner financing, and they would get 1 out of 100. And that's how they built their portfolio. And this was back probably 25 years ago when they wrote the book.
Anthony said, Invest in Debt. That's another good book.
That is an excellent book. It does not help you with necessarily, Jimmy Napier is just a brilliant guy. I haven't heard how well he's doing. He's getting a little bit older and has some health problems, but I've been to several of his courses, and he's the kind of guy that I can just listen to him read the phone book. I mean, he just has that kind of way about him. But excellent book, and that is conceptual in approach to how to invest in debt. But it's kind of dated because it talks about getting 18% return on your tax liens, which is not possible anymore. Okay, so it is 7:22. Any last questions before we bounce tonight, guys? Guys and gals? That's all there's to it. Okay, let's put some comments in here. What do you want to hear about next? We can talk about lease options. We can talk about exit strategies, where we go into more depth about how to find tenant buyers. What else can we talk about? Landlording.
I think landlording would be good because, one of the things I think we talked about early on with the whole COVID-19 is having the policies in place and just kind of talking maybe about a little in more detail of what it takes to, manage property and stuff like that. And,
okay.
Yeah.
best answer I know is to find a really good property manager, because personally, I'm not a good property manager. So,
Well, I can't say if you are your own property manager, we have found that it's really good to do the extensive work on the front end to really put in that A player in your unit.
Yep.
oh, you do the screening, yeah.
Yep.
Mm-hmm.
Screening is a big piece of it, and being firm on policies. That's one of the things that I believe has really helped us out to have long-term tenants.
I think I agree with that. That's probably the reason why I'm not a good property manager, is I'm too nice. I mean, I'm such a pushover. People tell me their sad stories, and I'm like, oh, okay, well, I guess you can't pay. I'm like, no, pay. No.
Well, the very first time you kind of let them milk the cow, so to speak.
Yeah.
They keep coming back.
It's like that book. You give a mouse a cookie, and that never stops. So yeah, you need an enforcer for sure. Yeah. Okay, so we'll think about landlording. Any votes or anything else?
Anthony says KPIs on marketing.
You come with that? Yeah.
Sure.
Once I figure it out, I'll let you know anything.
Yeah.
That is the magic to this business is in the marketing, and or how to find leads, Scott, and it is a constant, never-ending, changing battle. There is no one size fits all answer. It's a bunch of hustle and a bunch of throwing stuff against the wall to see what works, and it changes per market. It changes during the market cycle even. So that is a lifelong learning opportunity.
Yeah, it's ever changing, and the biggest thing is you have to be able to adapt, especially, if you find that text is working and then now text is not working, you have to be able to move and adjust, as well as test different motivations. I mean, you're constantly testing, and that's really marketing, right?
Yeah.
You're just always testing what works and then scaling what does until it doesn't.
50% of your marketing is going to generate all of your leads. You just don't know which half.
Yeah.
So that's, if you knew exactly which half, you'd be way better off. He mentions texting, and that's probably what we're doing the most of now is texting.
Yeah.
Okay. Well, that'll be another topic another day. Let's see if there's any other. If you're doing a 20 to 30% below market value for purchases before COVID, how much are you stacking on top of that with the COVID discount? Another 10%, I would say. Yeah, or if I'm just really confident in the house, I'll still buy it at 30% off. But I'm thinking about, in my mind, another 10% off.
Well, it depends what market you're in. 10% in our market is very little.
Yeah. Because just like the Mayo formula in our market, we're using 70. We were using at times 75. Now we'll use like 65 or 60. So 60 is probably like the new norm for the COVID discount in our market. But in Denver, they were using 82%. So they might be using 75 now. So it depends on your market a little bit. Yeah. Okay. Well, I think that's our last question. We're going to call it. It's been about an hour and a half. I enjoyed all y'all's attention, and stay tuned for another one next week. Appreciate it, everybody. Bye.